tax liens and civil judgments are no longer eligible for being reported on a consumer's credit report.
Interesting.
Now, lenders
That's
get
big
a
update.
supplemental report
Yeah.
that will show if those exist.
Sure.
But for the consumer, they're no longer embedded in their credit file, which means they can't impact the credit score in a negative manner.
Credit is one of the most misunderstood and also one of the most important aspects of your homeownership journey. That's why I'm so excited to be joined by Mike Olden, Vice President of Sales and Education with American Credit Reporting Company. Thank you very much for joining us today.
Well, thank you, Carice. I am delighted to be here. I think we've known each other longer than 25 years, back when your dad had a mortgage company, probably in the late 80s or so. So probably over 30 years. But I'm really delighted to be here. And I feel it's an important subject, not only for all of us as professionals in our industry, but for consumers. And we're all consumers.
Yes, we are all consumers. Yeah. And credit drives everything. It drives everything in our lives.
It does. I was just traveling the last couple days, and you can't check into a hotel without a credit card. You can't book a flight or a lot of things, rent a vehicle without some type of credit. So, and certainly in our industry, in the mortgage banking industry, it is one of the foundational items that will help a borrower become a homeowner.
Absolutely.
And a successful homeowner.
Yeah, absolutely. And it's something that it's a very emotional issue for most people. It's scary to them. They don't know where to start. There's so much misinformation out there too. And I know you and I've talked so much over the years about the misinformation that's out there.
There is. And I feel a lot of it is well-intentioned, but it's not always accurate. And one of the things we do at American Reporting Company, besides providing credit reports or appraisal management to lenders like yourself, is to inform, educate, and encourage our clients, colleagues, and consumers. So it's very important.
It definitely is. I mean, it like you said, it affects every aspect of people's lives. And probably one of the biggest questions I get is what drives the credit score and why is it so important for people? So I would love to have you address that.
Well, why it's so important, I guess I'll leave that to the lender and your investors like Fannie Mae or Freddie Mac or others who purchase loans, why the credit scores are so important. But we certainly can talk about some of the key elements that drive the score. And we want to remember when you have a borrower come in to talk to you and you pull their credit report, it's a snapshot in time. So you're looking at what's being reported, good, bad, or indifferent at that moment. And that's how the score is calculated. And there's 5 key factors. Number 1, that's most important, are we making our payments on time? And that means never more than 30 days past the due date. Number 2 is how much of the credit we're using, especially on credit cards. What's the proportion of the balance to the credit limit? Number 3 is the types of credit or the mix of credit. Do we have a good balance of different types of accounts? 4th is how long we've been using credit. Now, we've seen consumers that have a very young file, maybe 12 to 24 months, that have scores in the upper 700s. But typically, the longer you've been using credit, the greater likelihood you're going to have a strong score. And then finally, our applications for new credit, inquiries. Are we applying for a lot of new credit? All those 5 factors contribute in various amounts. The first 2, making our payments on time and how much credit we're using, that accounts for 65% of what determines our scores.
Wow.
So that's the bulk of it right there.
Yeah. Well, and the different types of credit, like you were talking about, revolving, credit cards versus, different credit, like a car loan or a student loan. How is that taken into account differently too?
Well, the three areas where you have not as much impact based on the balance are mortgage loans,
Mhm.
auto loans, or some type of vehicle, maybe a
Yeah.
boat or a motorcycle,
Yeah.
and then student loans. So I'll ask you, what common characteristic do each of those types of loans have?
Well, it goes to character, goes into the character, and it's a monthly payment, a fixed monthly payment they got to make every
It's a
month.
monthly payment, and if you don't make the payment on those items, what happens?
They default and they're going to be foreclosed upon.
And
Repossessed. Yeah,
repossessed.
repossessed
Yeah.
on a,
So
yes, versus,
those are secured
yeah.
loans or secured
Yep.
accounts, whereas a Target card, a
Yeah.
Visa, a MasterCard, Nordstrom,
Mhm.
those are unsecured accounts. There's nothing backing those up except our promise to repay them. It's our signature. Years ago, we'd call those signature loans because that's what's backing it up. So they're higher risk. If a consumer is carrying a lot of unsecured debt, when you pull the credit report, even if they've made all the payments on time, never had a late payment, there's no collections or any negative items on there, the score still could be quite a bit lower than what many consumers expect because they're carrying high credit card balances. And if they default, there's nothing backing that up for the lender, the creditor, to recoup short of collection or legal action. Whereas a home, a car, even a government-backed student loan, there's collateral. There's something is backing it up. And the investor can recoup some of their loss on there. So we want to encourage consumers, when they're getting ready to become homeowners, before they even come to you, they should look at their personal credit report. And these days, you can go to annualcreditreport.com, which is the official free site, and pull your free credit report once a week. It used
I
to be
didn't
once a
realize
year.
that. Once a week?
Once a week.
Wow.
That's because
Okay.
of the pandemic a few years ago.
Yeah.
They increased the availability of our personal credit reports. They don't come with scores, but I think what's most important for consumers who are getting ready to become homeowners, review your personal credit report. Make sure that everything that belongs to you is accurate and up to date. Anything that might be outdated or you don't recognize, you address that before they come and see you, so they prepare themselves. And that includes, I think I need to pay down some credit card balances to optimize my credit score before you pull their mortgage credit report.
How long does it typically take? Because that's a question I get a lot from consumers is, okay, I want to pay down some credit cards. How long after they have paid those credit cards down will it reflect in the credit score?
It could be a matter of days. It could be a matter of weeks or into next month. It just depends on the cadence of when the creditor reports that account information to the credit bureaus. When I started in this business back in the mid 80s, typically creditors reported in the first week to 10 days of every month. It's spread out all over the month now.
Interesting. Okay.
So if you can determine when your creditors are going to report to the bureaus and make those payments, then they can communicate to you, okay, all of my accounts report in the first 20 days, so pull my credit report after the 20th of the month, just as an example. And that is not a hard and fast rule, but just for illustrative purposes.
Interesting. Okay,
Yeah.
kind of wait till a little bit after the 20th.
Yeah.
That's a good tip.
Well, it may be before the 20th, it may be after the 20th, but the important thing is when you're making your payments on your credit cards, try to find out when they're going to report that account information to the bureaus.
Okay.
And I don't know, I know you work with a lot of experienced borrowers. Do you ever have borrowers who pay their credit card balances in full each month?
Yes, quite a few.
Okay.
Yes. And they're always surprised when they get the report. And they're like, but there's not a balance on this. And I always explain to them, well, it isn't in real time. It's a snapshot in time.
Exactly.
But I would love to have you kind of share what a borrower can do. Let's say, because a lot of times it doesn't make a difference for them to qualify. It's fine if the credit card balance that shows has a payment of $100 a month. They're going to qualify still. But sometimes it does make a difference. So what can we do for those clients where we really do need to make sure that we've reported that that is paid off?
Well, I'll go back to consumers reviewing their personal credit report. I feel that's the first thing they should do.
Okay.
So go to annualcreditreport.com or there's plenty of other sites. You go directly to the 3 major credit bureaus. There's a lot of consumers that use sites like Credit Karma, Credit Sesame, whatever it is. Pull up your most recent credit report, your personal report, review that. If you have accounts, credit card accounts, unsecured debt that has high balances over 25% of the credit limit, work on paying those down as much as possible. That would be the first couple of items there. I think other things to prepare yourself is when they start working with you and a realtor, don't apply for any other credit.
Yes.
I've talked to some of our realtor colleagues who have told me that their buyers will drive up in their new truck, or they've gone out and bought new furniture. They went on a vacation before the transaction was completed. And tell me, as a lender, do you ever need to pull a credit report prior to closing?
Yes, we do.
And what are you looking for?
We're looking for increased debt because as lenders, we're required now under federal regulation to do credit monitoring during the whole process. And what we're looking for in that is, have they applied for any new credit? Is there anything that's new that's now it falls under what's called undisclosed, so that we need to add that into the debt to income ratio? Sometimes they will still be okay and they'll qualify. But the fact is, I think what's more concerning is sometimes it can push out closing. So it's not even so much qualifying. It's a lot of times when you get a brand new, let's say it's one of those, you go in, I want to buy new furniture and it's 0% interest. You get 20% off the purchase. I want to get this credit card. It's going to take 30 days for you to actually get the credit card. When you get approved, a lot of times they don't give you the full 16-digit account number when you go buy that. And so we can't add it to the credit report until we know what that full number is.
Right.
And that can really delay closing. But most of the time, the biggest concern is, yes, we're looking for an increase in debt on the credit cards. If it went from a $5,000 balance to a $25,000 balance, there's going to be an increased payment we have to factor, new credit, and stuff like that. I tell people whenever they apply, do not, under any circumstances, especially when they've gone into contract, do not buy anything until the day after closing. After closing, you're fine. Do anything you want.
Exactly.
Yes.
And the delay is something that happens quite a bit. And they think, well, it's not going to hit the bureaus. Well, sometimes it hits the bureaus really quickly. And you brought up an example of going out and buying furniture, and we're seeing more of a trend of buy now, pay later accounts. Maybe when our parents were younger, you used to go and buy something, and it would be on a house account. Same type of concept there, where you just go in and buy all that furniture, and it's zero down, no payments for 3 years. And you think, oh, terrific, that's not going to hurt my credit. Most of those companies will report the full amount to the bureaus in that first month. So if you go out and buy $10,000 worth of furniture.
Yeah.
You may not have any interest or payments for 3 years, but they're going to report it to the bureaus, and it's going to show a $10,000 limit and a $10,000 balance right away. And that may have an impact on your credit score. And sometimes it can be significant to the overall picture because there are different pricing tiers, and you drop just a few points below those.
Right.
How many exceptions are there these days?
There's not exceptions
None.
on credit.
Almost none.
No.
So we want to be very mindful. And again, educate and encourage borrowers once you start that process of purchasing a home or even a refinance. No new credit applications. And you see this, we're tempted all the time.
We are.
You go to a department store and you want 10% off, apply for the card. You go to the ballpark or a stadium and you get a free towel or a t-shirt, but you're signing up for a credit card. On the airlines, sign up for this credit card and you get 250,000 miles.
Yes.
Well, that's only if you qualify.
Right.
But the inquiry is there
Yes.
for more unsecured debt. So we want to avoid applying for unsecured debt. So I think probably the 3 most important things that consumers can do in preparation before the lender pulls their credit report. Review your personal credit report for accuracy and also to see if there's anywhere where you can impact the score by paying down credit card balances. And then don't apply for any new credit. Sometimes emergencies come up.
Sure.
But barring an emergency, don't apply for any new credit or open new accounts. And if a consumer does that, they've really set themselves up for success.
Yes, for sure. I totally agree. And that's one of the questions that comes up. Another thing that comes up that you touched on was talking about inquiries. That's a common question that we get, especially, clients that come to us for a pre-approval and they're concerned about a hard inquiry. And I would love to have you touch on that because there's different types of inquiries and they impact scores very differently.
Exactly. There's 2 types of inquiries. There's a hard inquiry and a soft inquiry. A soft inquiry is when we go to a site such as annualcreditreport.com or Credit Karma or the bureaus to pull our personal credit report. No impact. When we apply to rent an apartment, when we apply for a job, or insurance, typically no impact. When a lender pulls our account to review the account, that's a soft hit report, soft inquiry. A hard inquiry is when we as consumers initiate an application for the extension of credit. That's going to be a hard inquiry. When I do homebuyer classes, one of the first questions I ask is, of the students, who can tell us the average number of points from an inquiry? So I'll ask you, what do you feel are the average number of points that an inquiry would impact our score?
Typically 3 to 5 points.
Right. Yeah, under 5 points. And one of the resources we're going to share with our viewers today is a terrific overview from FICO. And FICO is the company that provides the credit scores in our industry, the mortgage banking industry, amongst others. And they've put together a really terrific piece on inquiries that we'll share with everybody. But also within our industry, FICO and the bureaus put their heads together several years ago and said, let's not impact mortgage applications as much as, say, a credit card. So as a consumer, you're a consumer. When you're applying for credit, what are some of the things that are really important to you?
Well, when you're applying for credit, you as a consumer, you want to get approved. You want to get approved for whatever it is you're applying for.
And what else are you looking for when you apply.
Like what to, the one you want the best terms possible.
Exactly.
Absolute
The
lowest
lowest
rate,
interest
lowest-
rate.
Yeah,
So
absolutely.
another colleague many years ago, he gave me his definition of credit. Credit is the cost of money. And the cost is the interest rate. As consumers, we all want the cheapest amount to pay for the money we're borrowing,
Yes.
whether it's a credit card, an auto loan, a mortgage loan, a student loan. We want the lowest interest rate possible. We achieve that in part by our credit scores. If we've managed those well, make our payments on time, keep our credit card balances low, limit our applications, that's going to increase the opportunity to have higher scores. The higher the score, the lower the interest rate. The lower the interest rate, the more money you can lend.
Yes,
And
this is true.
and then our realtor colleagues have many more opportunities when that buyer is looking for a property.
Yeah.
So
Yeah.
what FICO and the bureaus did several years ago is said, let's not penalize consumers for rate shopping, because they're going to shop for rates on mortgages, auto loans, and to a much lesser extent, student loans, the three major categories of secured loans. So within each of those silos or buckets, you can have multiple inquiries over a period of time, and they're only scored once collectively. In our industry, Experian has the oldest credit score model, so that's a 14-day window. TransUnion and Equifax have more up-to-date score models. It's a 45-day window. Soon, all three bureaus are going to have the same score model, hopefully by the end of this year, early next year. And then it'll all be 45-day window.
Why is Experian tagging behind?
Because they have the oldest FICO score model, version 2.
Okay.
Beginning with version 4 and 5, that window expanded out to 45 days. So it's just a timing thing in our industry, but we'll get there.
Sure.
We'll get there.
Sure.
But I think what's important, consumers shouldn't be afraid of applying for credit. We just want to help them manage it well so that they can get the highest scores possible. And that's going to open up so many more opportunities, not just in our industry, but any area.
Absolutely. Oh, absolutely. And even as industry professionals, like I feel like I always learn at least a few new things whenever I talk to you about credit, because it's always changing. And the nice thing is it's amazing how it's evolved in the last 30 years. I mean, I still remember the days when we had to actually order a credit report and it took 2 weeks to get it. And now, of course, it's instantaneous, but it's amazing how it's evolved. The other thing, one of the most common questions I get is I'll have a client that says to me, well, I checked my score on Credit Karma and it's 800. And then when we pull the credit report, it comes in at 750. And it's always an interesting conversation, but I'd love to have you touch on that, on why those differences, because there's some pretty significant differences and good reasons why.
There are differences. It could be anything from the timing of when the reports were pulled. So they may have pulled their personal credit report 60 days ago, and then they come in and you pull it today. Well, that's 2 months of activity that could have been updated to the bureau. So that's one reason. But the major reason is FICO and then Vantage, which is their primary competitor, and Vantage is owned collectively by the three major credit bureaus. Those are different score models. Now, they basically have the same 5 key factors that we discussed a few moments ago, but they're still different. And one other major difference is if a consumer has no credit score today and no credit, and they open up a new account tomorrow, in order to generate a FICO score, that takes 6 months of usage and on-time payments and so forth. For a Vantage score, it only takes 1 month to generate a score. So oftentimes you will see Vantage with their their white papers, their headlines. We could score several million more Americans to become homeowners. They can because they have a much smaller window to generate a score than FICO does on there. So those are differences. But the good news for consumers is both of those major score models have the same score range: 300 on the low end, 850 on the high end. So again, the higher the score, the lower the interest rate, the greater the opportunity. But you probably know as a lender, just because somebody doesn't have a 750 or 800 doesn't rule them out from being a homeowner.
Heavens no, not at all.
And that is another item I like to stress when I do homebuyer classes is whatever your credit situation is today, especially if it is somewhat precarious, don't be discouraged.
Yes,
Credit doesn't stay with you forever.
Yes. And that's important. That's an important distinction to make, because I think people a lot of times will carry a lot of personal shame around credit.
Oh, sure.
Maybe they went through a tough scenario and they had to declare bankruptcy, or they had some late payments. And, we've been in this business long enough that this happens all the time. Like life happens.
I've gone through it.
Yes.
Years ago, when you're young and you think you're invulnerable to things, and you're not.
No.
But you learn. But
Yes.
you learn that it doesn't stay with you forever. In general, credit is reported for 7 years. Bankruptcy 10 years, but 7 years. So even if you had a couple of missteps, it's not going to be there 20 years from now.
It drops off.
And I have helped teach loan officers at homebuyer classes where somebody will say, well, I had a 30-day late on a Target account 2 years ago. There's no way I could be a homeowner. Well, that's not the case.
Correct.
And you as a lender know that your underwriting guidelines, your investor guidelines. That is not the case.
No.
But there is a lot of misconception out there. A lot.
Oh, there's a ton of misconceptions, and people are afraid. They're worried because of those misconceptions. But you and I both know, yes, I mean, there's so many different loan programs, amongst, the USDA and FHA and VA and conventional. You can have scores that range. They run the gamut. They could be 575 to 850, and you can still get a loan.
Exactly.
And we're trained to provide good resources to people if we do pull a credit report and there's some challenges there that need to be worked on. We can help the consumer create a good plan. That's one of the most important things I think we do as lenders, as counselors. That's our advising role that we're doing, is advising and giving good counsel on good resources, because there's a lot of scams out there. And I would love to have you talk about that, because in the credit repair world, there's a lot of scams out there. There's some very good legitimate resources out there for consumers, but I would love to have you touch on that, because that's an important one with consumers.
It is, and it oftentimes sounds so good and so easy. And our human nature is to look for the least offensive path to solve our problems. But we do want to caution consumers about credit repair scams. And if you go to the Federal Trade Commission's website, ftc.gov, and type that in, you will see those on there. Or you could go to the CFPB and look for those items, and they can do so much more damage for consumers. And sometimes they pay hundreds or thousands of dollars to miraculously make things disappear that are legitimate, and they can't do that, and then they're out the money. They'd be much better served taking that money, paying down high credit card balances, paying off legitimate collections, or if they're going through a Chapter 13 bankruptcy or consumer credit counseling, rather than paying somebody who's promising them, I'll make this go away, and many times they can't. And then they're in a
Ah.
much deeper situation. And then they are really embarrassed and ashamed that they were taken advantage of. I always feel that if somebody has legitimate counseling needs, we should refer them to HUD's website, HUD.gov, for a HUD certified counselor. And where we are here in the Pacific Northwest, Puget Sound region, we are blessed with so many terrific nonprofit housing counselors here that are on HUD's website. And that's really the best place for them to go. And then working with the loan officer, because you know your underwriting guidelines, you know the
Yes.
investor guidelines. And if you pull the report, I always encourage our clients, sit down with your borrower, look at the credit score page, what's causing those scores to be where they are that day, and then go through the credit report, highlight those items that need to be worked on.
Yes.
And if it takes 6 months, if it takes 2 years, it's better than putting yourself into a deeper hole by paying somebody for a miracle that is never going to happen.
Yeah.
Or rarely will happen.
Exactly. And it's too bad that there's those scams that exist out there, but
And we see a lot of them.
Yes.
In the last few years, when our industry hits a valley like it has, interest rates have gone up, affordability has gone down, and people feel that there's no opportunity for them. That's when a lot of these companies come bubbling up out of the ground, and people want to be homeowners and say, well, that sounds terrific. And most of the things they charge for, we as consumers can do on our own. And what we're gonna share a resource guide with today's viewers. And one of the sections on there is from the Federal Trade Commission, how to avoid those scams, those credit repair scams. And I think the FTC is really one of the very best resources for professionals in our industry and for all of us as a consumer. That's what they were formed for.
Yeah. 100%. Absolutely. And we will include these resources as links on the post so that consumers can know exactly where to go to kind of look those up. They're great resources. But you had touched on what we call those score factors.
Right.
What I always find, that's a really common question is, when you pull a credit report and there's those little score factors that come up, and I would love to have you kind of talk about that. How do those score factors, how are they determined? And also a little bit about when they show up, how a consumer looks at that as guidance towards what they would need to do to help improve their credit situation.
I like your word guidance because that's really what it is. And at American Reporting Company, our staff, we receive calls daily from our clients and their borrowers of, help me understand why I have these scores and how I can improve them. And that's the first section that we're going to look at, because that's our roadmap. That's giving us clues to what we're going to find inside the main body of the report. That score page is a great indicator. So, for example, those factors that you mentioned, officially known as reason codes. What's the reason that we're seeing these scores? And there's usually 4, sometimes 5. They're listed in descending order of importance. So if the number one reason code or score factor is proportion of balance to credit limit on bank or credit card accounts is too high, well, then immediately we know when we look at the report, there's going to be credit card balances that are at least over 25% and oftentimes over 50 or 60%. If it says serious derogatory item or collection, well, now we know we're going to find accounts that have late payments, or we're going to find actual collection accounts, and so forth. When we order our personal credit report, we don't always see the credit score. Sometimes we have to pay extra for that, but usually you'll see those reason codes or score factors in there. And I encourage consumers, check with your bank, your credit union, your credit card company. They often deliver FICO scores for free.
Yes,
I've got a
they
couple
do.
of credit cards that you go onto the website and there's a button that says, click here to see your current FICO score. Or you've got a little thermometer on there that says your current score is good. Click here to see what's impacting it. And you can see those codes. But we just want to remember they're listed in descending order of importance. And the first two, that should give us an indication, okay, I've got high credit card balances. I should work on that. I should work on getting those down below 20 to 25% of the credit limit to optimize my scores. They don't have to be paid to zero. And we certainly don't want to close the account because that could impact the overall age of how long we've been using credit, which is one of the 5 key factors.
And that's a big question that comes up a lot from consumers. Well, should I close it? And I'm always like, no. Actually, pay it off, but don't close it because it does affect the overall number of accounts that's being reviewed, right? It takes it out of the number. And so now other accounts are going to be more impactful. So if there's a derogatory, it's going to impact it adversely even more. Am I correct on that?
Theoretically, yes. So if a consumer has 3 accounts and 2 were opened in the past year and 1 was opened 10 years ago and they closed that account, now their oldest account is less than 12 months old.
Yes.
And that may impact it. How much depends on the overall file. Maybe it's minimal. Maybe it's 10 or 20 points. Well, that could make a huge difference in their pricing.
Yes.
And what they pay for that mortgage. So we always encourage when a borrower calls in, we will go over the report from a technical standpoint, but we always defer to their loan officer and say it's important to talk to your lender because they know what the underwriting guidelines are. They know what the investor guidelines are. They're the ones who can give you that guidance on what you should or should not do.
A lot of times clients don't realize that in addition to the score, it's not just the score. In lending, some investors for some loan programs, typically it's jumbo loans. Fannie Mae, Freddie Mac, not so much, but it's the jumbo loans have additional credit requirements for a certain number of accounts or trade lines, as we call it, but a certain number of accounts. So what we were just talking about with closing out an account, now we have a closed account. And let's say the guideline for this jumbo loan program requires 4 open and active accounts going back at least 12 months.
Right.
And so now if the consumer has closed one of those accounts just last month, now I can't use that in my account. And it can really affect a person's ability to qualify for a certain program. Maybe that particular program would have been the best pricing for that on that particular day. To your point. So it's so important. And that's why we in the industry work as a team. And it's a total team effort because it all works together. It really does all work together.
Exactly. And I believe jumbo loans have sometimes even stricter requirements on usually a much higher credit score than conventional loans or certainly more than FHA or VA, which there's a lot more flexibility there. So just a little nuance could impact. It may delay it. It may even stop it completely.
Yes.
So we really want to nurture the borrower through this process once they start. And a lot of it is educating them up front, giving them the information, such as what we're talking about today. How can they best prepare themselves to be ready when you pull the credit report and when they're working with the realtor? And we're in a purchase market today. We're not in a refinance market.
Right. Exactly.
My interest rate on my home loan is 3.75. I'm not going anywhere for years unless I absolutely have to.
Yes.
So that opportunity isn't there. One thing we don't want to see borrowers get pushed down the line in a purchase because they did something
Yes.
or they
Yeah.
didn't do something. So, for example, before we came online today, you were asking me about credit freezes and credit locks
Yes.
and the impact there.
Yes.
And if many consumers put a freeze or a lock on their credit file for security, that prohibits unauthorized third parties from viewing their credit. It's a great program. It doesn't cost anything. But if they forget to remove that temporarily and you pull their credit report, you don't see all of the data. And if you can't see all the data, you can't get a pre-approval. And now I've seen recently many realtors have said, I'm not showing any homes to anybody without a pre-approval letter from a lender.
Yes.
And not lifting a freeze or a lock could put them into that category.
Exactly. It slows things down because
Yeah.
it can take days for a freeze to come off. I mean, I've had situations where sometimes it comes off quick, but sometimes it's taken days, or somebody forgets their login or their password. That can be problematic.
Yeah.
Yes.
And it in practice, the lock or freeze should come off within hours. Or within a day at most. But here a few months ago, I went to purchase something and I forgot that I had put a temporary freeze on that card because I thought I had lost the card.
Oh,
well,
yes.
The dry cleaner had it. It was left in a suit jacket and I had forgot to remove that. So you go into a restaurant, it's like, Mr. Olden, do you have another card? Because this one doesn't work. And it's very easy to do it on our phones.
Yes.
You can go into your account on your mobile device and you just slide that little button that says freeze or lock. And so it's easy to do it within the account. The actual credit freeze or credit lock is done through the credit bureaus. But that's a question we always encourage our clients. Ask your borrowers before you pull credit. Do you have a freeze or a lock? Do you have a dispute on your credit file? Sometimes those will not go through automated underwriting.
Yes.
And those are all things that we can do to help borrowers prepare to be successful in the home buying process.
For sure. Well, and along the lines of the credit freeze, there's been an exponential number of borrowers we've seen in the last 5 years. And I think it's been driven by a lot of these hacking events that have happened where, people's credit's been compromised. And I think Equifax had a big one.
That was in 2017. I was impacted by that. Fortunately, no harm, but everyone from Equifax, the old Starwood hotels, local archdiocese, any number of security breaches. So you're correct. Many consumers have taken advantage of these free services from the bureaus to put those security measures on. And that's one thing. There are a lot of opportunities for consumers to lock down their files, to monitor their files. But I encourage consumers, go to the bureaus first. They own the data. If they do have a fee, sometimes it's much lower than a third-party for-profit company that's offering the same service. So start with the bureaus, and we're going to have those resources in the guide.
Yes. So you can go directly to like Experian.com, Equifax.com, and actually freeze it at the bureau level versus paying a company that's out there that we hear advertising a lot.
Exactly.
That people have to pay for. Yes.
Right. And those might be great companies.
Sure.
We've seen many of them. They've got encryption, they've got security, but they're in business to make a profit, and they've seen an opportunity here. The bureaus do it for free.
Yes.
The same with a fraud alert. Now, with a freeze or a lock, if you want to place that, you have to call each or contact each bureau individually. With a fraud alert, if you feel you've been a victim of identity theft or fraud, you only need to contact one bureau, and by law, they must contact the other two. So that's a little bit easier. And you don't need to lift a fraud alert prior to pulling credit. That won't inhibit the delivery of the report. But a freeze or lock will inhibit that because you as a lender are a third party.
Yes.
You're not entitled to see that report until they lift it and give you permission to see it.
And even if there's a fraud alert, as a lender, our best practice is always we have to call and get a specific permission from the borrower. You have this fraud alert, just the underwriter
that is
actually
a requirement
calls.
That if a lender sees that, they are obliged to do it. And it's the same with a military lending. Anyone on active duty, if they have that alert on their file, the lender is obligated to contact them, or if they are unavailable, they are required to call their commanding officer and verify. Because what's the likelihood that somebody on active duty, or heaven forbid in a combat theater, is applying for credit that day?
Yes, exactly.
Almost zero
chance
that they're doing that. And that's an indication that there's potential fraud.
Well, yes. And there's additional requirements too, especially with active duty military, with credit and reporting requirements and so forth, as it should be. It's interesting though, you bring up the whole disputes, because that's a big one in lending that we run into, where somebody, let's say they had a disagreement with the creditor, and the creditors marked them late and they couldn't get it resolved, or maybe it's in the middle, they're trying to get it resolved. And so they'll put a note on their trade line that says consumer doesn't agree with the creditor, and the account's in dispute. Now, you brought up a very timely issue, because it impacts a lending approval sometimes. There's some programs that won't even allow a disputed account to be on credit report. And in some cases, it can shelter. Like, I'd love to have you talk about how it can impact a score and why it factors in.
And it can impact the score. And the reason that investors, especially Fannie Mae and Freddie Mac, the two largest purchasers of mortgages several years ago, any dispute, they wouldn't even move forward. Now they have backed away from that. And I'd have to refer to their selling guidelines, which disputes they might call out. But they were seeing a strategy 10, 12 years ago where consumers were disputing items, because when they're in dispute, that trade line is frozen out of impact on a FICO score. So it's almost as if it wasn't being calculated in there. Now, some aspects of the trade line were being calculated, the opening date, so for the age of the account and such. But if there were negative items on there, while it was under investigation, it wasn't being calculated into the score. So you were seeing this strategy of people just disputing wholesale on here. And that's why they implemented that. But to your point, there are still investors that will say, you've got to get rid of that dispute before we move forward. But in the resource guide, there will be links to an entire section on how to dispute credit reporting errors. Even, and this is at the Federal Trade Commission and the CFPB, they have examples, template letters. So it's very easy for the consumer just to plug in the appropriate items. Those two organizations have done all the work for us as consumers by writing the letters with the appropriate verbiage. You just put in the account name and the number you're disputing, and maybe why, a specific reason. So it makes it very easy to do that. But as lenders, sometimes your investors and underwriters won't allow it. So for the consumers viewing us today, just be prepared that your lender may ask you, what's the status of this dispute? Why are you disputing it? And they may just fill out a consumer letter of explanation, and that may be enough.
Yes.
But they may have to get it removed.
Yes, we've had cases where, and one of the greatest tools as lenders we're able to work with your company on is what we call a rapid rescore, which I'd
Right.
love to talk about here in a minute. But yes, on a dispute, I've had cases where, especially again on a jumbo loan, where the guidelines are a little bit more stringent, where you've got a trade line in dispute, so it's really not being factored in to the overall score and in the credit history. We've had to get the consumer to undispute it, but we as a lender can then order that rapid rescore, and that allows you go directly to the bureaus and get that updated and then rescored so we get what the real score is. And that's been really one of the greatest tools, because in the old days, a consumer would have had to wait a month for that
Exactly.
to be updated.
That's the quickest way. If an underwriter or an investor is requiring a dispute to be removed, the quickest way to do that is through a rescore, and which can be anywhere from 24 to 72, 96 hours, 2 to 4 days, typically at most. The good news for the consumer is they don't have to pay for that. That's the lender's responsibility, because the bureaus charge a premium to do that. The bad news for the consumer is it may lower their score, because now that negative account, or most likely a negative account, is live in the calculation of the score. So when we have completed those for our clients, oftentimes we do see the scores drop. Sometimes it's a little, sometimes it might be 40 or 50 points, and now they don't even qualify. So it's a little bit of a dicey situation there, but that's the requirements of our industry at times. It doesn't always happen, but that is the quickest way. And to your point, without that, you could wait maybe 30 to 45 days for that request to be resolved. And in a purchase market, we don't have that kind of time.
We don't. And the other nice thing is, like, there are times where we'll pull a credit report and there is a item showing that is legit incorrect. Like, the borrower's like, no, this is definitely erroneous. That's what that rapid rescore allows us to get that resolution quickly, because we're in a purchase market where, it's Murphy's Law. They found the house. They're in love with it. They need to make the offer. We pull the credit report and something comes up. So having that 3 or 4 day ability to get something rescored and resolved is a huge benefit.
It's a terrific tool. And we have staff at ARC that's all they do, along with analyzing a file on the front end and then processing the rescore on the back end. So it is a really good tool, and it benefits everybody. It benefits the borrower. It benefits the lender. It benefits the bureaus, because they get a fee for it. They charge a fee. But again, the good news for the consumer is they don't pay for it. The lender picks up that cost.
It's a cost of business.
It's a cost of doing
as a
business.
lender.
Right.
Yeah. I wanted to kind of touch on collection accounts, because that's a big one with people. And there's been some changes with medical collections that are positive for consumers. So I'd love to have you kind of bring us up to speed about that.
And I was, had issues with an erroneous medical collection several years ago, and I had all the paperwork from the insurer and went back and forth, and it took me several months to clear up, but I did. But this happens a lot, where you've got the patient, the borrower, the insurer, and then the provider. the doctor, the hospital, the clinic. And sometimes there's clerical errors and the communication breaks down and things don't get posted properly or in time. And medical collections show up. Here a couple of years ago, I remember there was a statistic that came out that 43% of credit reports had a medical collection on them, which I was astonished. I didn't think it was that high. But and many medical collections are under $100 or were. A couple of years ago, there was an agreement between several states' attorneys general and the credit bureaus, because those attorneys general felt that there were too many mistakes on credit reports in regards to medical collections. So the agreement was any medical collection, paid or unpaid, under $500 is not eligible for being reported on a consumer's credit report. Any medical bill that is turned over to collection that is over $500, there's a 12-month cooling off period before the collection agency can even report it. Just for the scenario I described that I went through a few years ago, because there's some type of clerical error. And they wanted to give everybody an opportunity to get that sorted out before it hit that consumer's credit report. Because if today you don't have any negative items or collections, and tomorrow you do, that is a huge drop in your score.
Yes.
We've seen sometimes upwards of 90 to 100 points.
Yes.
We talked a few minutes ago, say a jumbo loan just falling off a few points. Imagine 100 points. Then it's done.
Yes, it's done.
So those are really good developments for consumers. And even before, a few years before that, tax liens and civil judgments are no longer eligible for being reported on a consumer's credit report.
Interesting.
Now, lenders get a
big
supplemental report that will show if those exist.
Sure.
But for the consumer, they're no longer embedded in their credit file, which means they can't impact the credit score in a negative manner. It doesn't mean that tax liens, judgments, or medical collections don't exist if they're legitimate. They may. The consumer is still obligated to pay them. Lenders are going to want to know that because it could impact their ability to repay. But they can't be reported on a credit report.
On a credit report,
And you may recall a month ago, the CFPB came out with a new rule stating, beginning March 17th of this year, no medical collections were allowed to be reported any longer. There was no cap on the dollar amount, anything. It was just across the board, no medical collections. Well, now in the past couple of weeks, the CFPB is in a little bit of limbo. Under the current administration. So we don't really know where that is going to land. We're going to find out in about 3 weeks on St. Patrick's Day, which is when that was scheduled to go into effect, if it still goes into effect or if it's on hold. But the good news for consumers is that those pre-existing rules, all medical collections under $500 are no longer eligible for reporting. And the majority of medical collections are under $500. They're under $100. A $25 radiology bill that's easy
like
to forget. The copay, and you just, I'll take care of that at the end of the month, and then you forget about it. And 60 days later, it's on there, and it dropped your score 100 points. So those are good developments for consumers.
Really good developments, One of the big things that comes up is we pull a credit report, and then clients start getting phone calls, and their phones ring off the hook from solicitors. They get calls, they get texts, they get emails. I get hate calls from these clients saying, "What have you done? You pulled my credit. And now I'm literally being bombarded. I have to turn off my phone." And they're trigger leads. And I would love to have you talk about this because it's amazing to me that this is legal by the
Yeah,
bureaus.
it is legal under the Fair Credit Reporting Act, which went into effect over 50 years ago. It's legislated by Congress, but it is legal for the bureaus and other third parties to sell portions of a consumer's information, including, oh, Mike just applied for a mortgage yesterday. I'm going to call him and see if I can give him a better deal. And the reason is, the bureaus own our data. We'd like to think we control our own credit files. We don't. The bureaus own that data. And right now, it's legal for them to do it. Now, at ARC, we've never sold trigger leads. It just really flies in the face of our partnership with our clients. We don't want to do that. But some of our peers have. The bureaus certainly do this. The good news for consumers is there are free resources for them to eliminate those, and they're going to be on the resource guide. One is opt-out pre-screen, which is for mail, old snail mail, and then donotcall.gov. And as a consumer, you can go on and register there. It takes maybe a minute at each place to register. And within a matter of days, you are basically masked to potential credit grantors. And if they violate that, there are some pretty hefty fines on that. And so that's why they're receiving those, is they never opted out. And when you pull a credit report, these other lenders receive triggers that consumer had a mortgage application, maybe amongst other attributes, but that's what they're looking at right there. So they contact them. It's very similar to, I don't know, do you and your husband get credit card solicitations in the mail?
Yep.
Okay.
Yes.
If you opt out through the opt-out pre-screen, you won't receive those any longer. But consumers who haven't done that receive it. Now, those are called acquisition triggers. And what happens is that creditor goes to one of the bureaus as the primary source, or maybe another third party, and they say, I want everybody in the 98199 zip code who has a credit score between 700 and 750, under $10,000 worth of credit card debt, and no mortgage lates and no bankruptcies in the last 12 months. That's the filter, and they get those and they solicit.
And they can buy those lists.
They can buy those lists
directly from the 3 credit bureaus.
Right, or other third parties.
Yeah.
And it's the same on the trigger leads, but the trigger lead in our industry is generated off of a mortgage application. You pulled their credit report today. If they haven't opted out, within minutes, they're going to be getting a call. There's some inherent dangers in there. You have to be licensed. Perhaps some of these call centers, those individuals aren't licensed, and yet they're talking about loan programs or interest rates. Last year, there were a couple of major pieces of legislation. Representative Torres from New York, Senator Reed from Rhode Island had legislation. And then at the end of the year, there was an amendment to a Department of Defense, a big bill that almost has to go through every year, but all of those pieces of legislation failed to put some clamps, some rails on trigger leads. I'm going to be back in Washington in April to meet with legislators on Capitol Hill. We'll see what happens at that time so we can update your listeners after that. But the goal was to really put some heavy restrictions on trigger leads.
Yeah.
On there, but we haven't seen that. But again, the good news is there are resources in place for consumers to opt out. It's free. It takes under 5 minutes to do both of them.
Yeah, that's really, it's get the word out. When I talk to a new borrower and I send them the steps to start applying, that's the number one thing I have on that list is go on to opt out pre-screen and donotcall.gov, because it can take up to 3 to 5 days on the donotcall.gov for it to
Right.
actually go through. And so I
Right.
said, do it now, because I don't want you to be bombarded when we pull your credit report. And it's not us that's sharing your information.
No.
It's not us that's selling your information. It's the actual bureaus, and it's perfectly legal. And
It is.
it's amazing to me when I talk to clients about this, a lot of times it's the first time they've ever heard about this. So the information, to your point, it's not readily out there. And it would be great if some legislation passes, but up till then, it's on us to really educate. And like you said, it literally takes a minute. I did it the moment that I first heard about that from you, probably 5 years ago now. I immediately went to it, and it definitely eliminates, well, it reduces greatly.
It greatly
your
reduces.
Inbox.
There are some exemptions. Certain nonprofits, religious organizations, museums, they're raising money. They're fundraising. They're exempt from that. You can read more in detail with the resources that we provide. But I would add that to, we were talking a few minutes ago about borrower preparation. Opt out before your lender pulls your credit report, and give it a few days. If you're thinking about becoming a home buyer, or you're thinking about refinancing, then build in a week to 2 weeks of lead time before you're going to talk to the lender. Make sure you've opted out. It relieves a lot of stress for consumers. It relieves a lot of stress for lenders,
for sure,
or your service providers such as ourselves.
Yes.
Because we'll get calls from borrowers going, "Who's American Reporting Company? I didn't authorize you to do this." And they would say, "Well, here's your lender." Yeah, well, still, who sold my information? You go deeper into the conversation and find out they've never opted out, and they didn't know about it.
They didn't know about it.
So it's another area where we can inform, educate, and then really encourage consumers to opt out.
Absolutely.
There.
That's in my opinion, one of the absolute most important takeaways.
Yeah.
And a really cool concept that's come out is this credit modernization. And I would love to have you talk about that. That's fascinating to me.
Well, and we talked a few minutes ago about the current versions of FICO scores used in our industry. You have version 2 at Experian, version 4 at TransUnion, and version 5 at Equifax. The most recent version is FICO 10T. Those versions are 20 years old. Wow. Now, it's the same base FICO score, and they're still valid scores. They're still supported by FICO. But over the years, they have modernized. If you go to, say, an auto lender or credit card lender and apply for credit, they're often pulling FICO version 8. So much more recent. And FICO version 10T is what is scheduled for our industry, hopefully at the end of this year, but more likely into 2026. The T stands for trended data, which looks at the past 24 months, especially on credit card payments. Is Mike making just the minimum payment, or is he making bigger payments, or is he making the full payment each month? That technology is already being used by Fannie Mae and Freddie Mac in their underwriting, but it's not impacting the current version of scores. It will impact the scores when that goes into effect. So that's another motivation for consumers to keep their credit card balances lower.
Yes.
Otherwise, if they're carrying high balances for long periods of time, no matter whether they paid the payments on time or not, it will drive the scores down.
Yeah, if they don't pay it off every month.
If they're carrying, they're just making the minimum amount. That trended data will be built into there.
Yeah.
But also in credit score modernization, we talked about some of the collection items, but they are building in both FICO and Vantage where non-traditional items could be scored. Things like your rent, your utilities, your telecom, insurance, which are typically called non-traditional items because they don't report to the bureaus. But in these newer versions of credit scores, if they're reported, they'll be calculated in. And we see a lot of younger adults today don't have traditional credit like we grew up with, or certainly our parents grew up with. So to help them, but really to help all consumers, you can generate a score off of what we consider non-traditional credit. Those new scores, FICO 10T, Vantage 4.0, were approved by Fannie Mae and Freddie Mac about 2.5 years ago. But our industry sometimes is slow to implement.
Yes,
but we're hopeful sometime later this year.
Yeah, it's great to see that things are moving along, and I'm excited to hear hear more about that when that ultimately rolls out.
We're going to see modernization in all aspects of the mortgage and real estate finance industry. Sometimes it takes a while, and then all of a sudden it tumbles very quickly into implementation. I think, for consumers, again, don't ever be discouraged with what your current credit situation is today. Talk to your lender, talk to their business partners. If you need counseling, find a HUD certified counselor or somebody through the National Federation of Consumer Credit Counseling, but stay away from things that sound too good because they usually
charge a fee.
Or charge a fee.
Because there's some great resources. And you're 100% correct on that. Consumers should not feel discouraged at all. No. This is our expertise, and we're here to help.
And don't be embarrassed or ashamed.
Exactly.
We've all been through it at times.
We have.
And I have, even though I'm in the industry, you go through those periods of indecisiveness or poor decision making, but you can come out of it, and you come out of it much stronger. Just like our industry is a little bit down right now, we always come out much stronger than when we went in.
Agreed.
And it's the same for consumers.
Yeah. I always say to clients, look, I'm not in the judging business. I'm here to help. That's what I do for a living. And it's people aren't experts in this stuff. They're living their lives, and
we don't teach it in schools.
We don't teach it in school.
And it's something, and I know I was in Olympia, our state capital here in Washington a few weeks ago, and one of the proposed bills is a requirement to teach financial literacy in the high schools as part of graduation. I think it's a great idea.
Yes.
I didn't really learn about credit until I got into this industry.
It would be phenomenal if that was taught in the high schools. It would be, because people come out and they don't know those basics. They don't know about credit. What do I do? When should I get a credit card? How do I build credit? They don't know about finances on opening a bank account. Just simple things like that. Definitely. I agree fully. One of the things that has been interesting to me is this credit modernization that has come about. And I'd love to have you talk about that, because there's some really inspiring things that
it is. It's exciting. As we mentioned a few moments ago, in the mortgage industry, we're still using older versions, older generations of FICO scores. Experian uses version 2. TransUnion version 4, Equifax version 5, whereas the most up-to-date versions are 8, 9, and 10.
Wow.
So those versions we use are about 20 years old. Now they're still valid. FICO still supports them. It's still the same base score model, score range, factors, but they are older. And when we get to that modernization in our industry, hopefully at the end of this year, early next year, we're going to see some benefits of that, and it's going to help consumers. It's going to give them greater opportunities. And it's the same with the Vantage scores as well.
One of the big common questions that I get from consumers is they've got negative marks on their credit. Maybe, primarily it's late payments. And they ask me, what can I do? So what would you say as a credit expert, some of the top things that a consumer could do that would impact that would help them as soon as possible?
I feel that if there are any credit reporting errors, that they file those disputes as quickly as possible with the bureaus. But let's assume that these are legitimate late payments or collections. Really, there's not much they can do except make sure those things don't happen again in the future. Put it behind them. The further we get away from when they occurred, the less impact they'll have on the score. This is exactly the type of situation where a consumer gets impatient, gets scared, reaches out to somebody who says, don't worry, I can get those removed, but it'll cost you this amount. That's what we don't want to do.
Right.
Now, in reality, I've talked to many consumers who have legitimate late payments, have legitimate collections. They've gone back to the creditor and they've said, you know, I want to become a home buyer. I'm working on my credit. Is there any opportunity for some forgiveness here? Sometimes the creditor is willing to do that.
Yeah.
But just make sure you get everything in writing. I've been on enough conference calls with consumers who apply for a mortgage, the credit report is pulled, the item is still on there. Get on the conference call with the creditor and they say, well, we don't have any record of this.
That conversation.
Oh, yeah, but I talked to so-and-so and they said they were going to remove that. A creditor is never obligated to remove legitimate derogatory items. Sometimes they're willing to do that as a customer courtesy, especially if that consumer has had an account for many years. You know, maybe you miss a late payment on a department store and you've had a perfect payment history. You're on vacation, you were sick, whatever the reason is. We have seen it so many times.
It's that Macy's $25 or Cap One.
Exactly.
$70, yes.
Or
yes.
a cable company sends your cable bill to collection, you forgot about it. You could go back to the cable company or the telecom company and say, gosh, I was on vacation. I didn't realize this was going on. If I paid you directly and made up for that, would you contact the collection agency and have that canceled and returned back? I've seen that happen many times, but we want consumers to remember the creditor is not obligated to delete any legitimate items, good or bad.
So get the moral of the story is get that in writing.
Get it
that
in writing.
Says we're removing this late, so that at that point, if they have that letter, we could then do a rapid rescore because it states that that creditor has agreed to remove that derogatory.
Exactly. And those letters should be specific. It shouldn't say, Dear Mike, thank you for your call. We reviewed your account, made the appropriate changes. The bureaus don't know what those appropriate changes are. So you want it to be specific. Dear Mike, thank you for your call. Upon review, we have deleted the late payment from January 2025. Please allow up to 90 days for this to be reflected. That's the verbiage that you want.
That's the verbiage. And typically, how long would you say? Let's say the consumer tries that and the creditor's like, I'm sorry, it was legitimately late. We've got to report it. How long does it really impact a score?
I would say in the first 12 to 24 months is where you see the majority of the negative impact. Once you get past that 24-month period, the further you go up to 7 years, it diminishes the impact. But it may still have an impact on the opinion of an underwriter. Because sometimes underwriting and credit scores don't go hand in hand.
Yep, absolutely. To what we were talking about before, especially on jumbo loans.
Right.
There are in many cases overlays or additional credit requirements that talk about you cannot have had more than one 30-day consumer late payment in the last 12 months or 24 months. And every loan program and every investor is a little bit different. So Yes. All these years in this business, you've seen everything and you've reviewed a lot of credit reports. What's the biggest piece of advice that you would give to a consumer who is wanting to prepare to buy and trying to get themselves in the absolute best possible condition that they can?
Well, I think the most important thing to remember is, again, don't ever be discouraged with where you are today, because credit doesn't follow you around. But from what can you do today, review your personal credit file. I've talked to so many borrowers who have not seen their credit report for years or ever until they come to see a mortgage lender.
Yeah.
And then they're surprised what's going on here. So it's free every week. There's such an opportunity to pull your credit, study it, learn how to read the credit report, and there's numerous resources for that. If you go to myfico.com, they have a whole education section in there, understanding your credit score, what impacts your scores. So I think start with review your credit report, look at the credit scores, look at the reason codes, why you're receiving those scores, then look at the inside of the credit report and determine what you can do on there, and talk to an experienced lender.
Perfect. That's great advice. I that would be great advice. If people did that, that would really help them be able to buy more quickly because they'd be prepared. It's so sad when someone falls in love with a house, but they haven't done the prep work. And then they come to me and I say, oh gosh, you're going to be able to buy, but it's going to be a process and we're going to need to talk strategy, but you're not going to be able to buy right now. And had they called me 6 months earlier, we could have discussed so many things and they could have prepared better.
Well, I think for our audience too, many consumers want to meet with a realtor first and go look at properties. They should come to the lender first because you have the money. And get pre-approved and then go look for your home. And you know what you are qualified for.
I always say to clients, like, we are the pathway to the front door. You have to come and see us first. Like, your realtor can't do anything for you until we have been able to pre-approve you and we can tell your realtor what you can afford. And that's why I don't blame realtors for not wanting to put clients in the car without a pre-approval letter. It's a lot of times, and it's the consumer they view their own situation through their lens. We have to view it through a very different lens. And those lenses a lot of times are completely different lenses. And so what the consumer thinks that they make and qualify for is very different when you get down into the way that underwriting guidelines require that you look at that kind of stuff. And it's always been probably one of the biggest hurdles and discussion points with potential buyers. And it still is that today. You're exactly right. They need to talk to us as the lender first so that we can really determine what they qualify for and then go fall in love with the house.
Yeah. Well, I talked to a realtor colleague here a couple of weeks ago, and she was one who said, I won't show anybody a home without a pre-approval letter because I don't have any money. The lender has the money. I don't have the money. That's a very good message for all of us as consumers to remember. But this is a collaborative industry. We all need each other to succeed. And we work together with partnerships. So we can work together. And because we all have a common goal of helping that person become a successful homeowner. Not just a buyer, but a homeowner.
Yes. And that's the best part of this industry. It is the partnerships and working together.
Yeah.
So, Mike, thank you so much for talking.
You're
with
welcome.
me
It's
today.
my pleasure.
We talked about so many great topics that are going to be so helpful to consumers. And thank you very much for watching. We're going to put those links below that Mike mentioned to all those great consumer resources. And as always, please subscribe and you'll learn more about finance and starting your home journey.